Many Bitcoiners have a stacking plan, but very few have an exit plan. How do you know exactly when you have enough to fund your life forever? In this episode of Bitcoin for Millennials, I'm joined by Trey Sellers, a former banker turned Bitcoiner who reached financial independence in just 5 years by understanding that stacking Bitcoin without a framework is a missed opportunity. We break down why Bitcoin doesn't just help you retire, but how it effectively cuts your retirement number in half. Trey also walks us through his Fire BTC Compass, a tool that helps you to understand when you can give yourself permission to stop optimizing for more and start living for yourself. If you want to stop working in 5 years instead of 30, this episode will change how you view the money you save from this day forward. If you're enjoying my content, it would mean a lot to me if you could subscribe to the channel and like my video to support my journey. Thanks a lot. Now let's dive in to this episode. All right, Trey Sellers, welcome back to Bitcoin for Millennials.
Bram, so good to be back with you, man.
Yeah, good to see you. I just told you I'm not the fire guy. You are the fire guy. You're the fire Bitcoin guy. So happy to have you back on. I think it's so interesting that Bitcoin brings something new into like a traditional mix, you know, and yeah, like I said, for fire, that is you. And so I just wanted to start there because I think there's kind of like certain rules or certain ideas in this fire formula that when you introduce Bitcoin, right, it kind of changes. Well, maybe you can explain it better, but you argue that when you introduce Bitcoin, you can actually cut it in half, which basically means you can retire earlier than following the traditional method of already retiring early.
Yeah, there's a few different ways that you can kind of look at it. The idea behind adding Bitcoin to your portfolio and being able to accelerate your journey to financial independence is just that it grows at a faster rate, or it has historically, and we expect that it will going forward. So I think that what's so great about merging Fire and Bitcoin is that on the one hand, I think a lot of Bitcoiners, they are very focused on the right things when it comes to just stacking sats and accumulating as much Bitcoin as they possibly can and holding on to it for the long term. But I don't think a lot of people actually think too formulaically or with too much structure about what their actual plan is. Like, how are they planning for the future? How do they know when there is enough that they have saved? I know you can never have enough Bitcoin, but and that's great. It's a good meme. I agree. You can't ever have enough Bitcoin, mimetically, but in reality, you can have enough Bitcoin if you plan on using that to fund your lifestyle. I mean, money is a tool. We save and we collect money as a way to improve our lives and, help make our families comfortable and buy the things that we need and want and go on the vacations that we want to see the world. It is a tool. And Bitcoin is no different in that regard, except it's just like a better tool, right? It's a sharper knife. So we get some advantages by pulling that into our portfolio. But that doesn't mean that once you start buying Bitcoin and you're focused only on buying Bitcoin, that you can just like leave everything else to chance or not think about what the implications are of how much you actually do need to fund your lifestyle. What does withdrawing the value of that Bitcoin after 10, 20 years or whatever, when you want to stop working, what does that actually look like? And what are the tax implications? How should you think about the Bitcoin relative to any other assets that you might own, right? I think, it's really great and easy for a lot of us to say, well, you should only own Bitcoin and you should be 100% Bitcoin and only buy Bitcoin and all this. And generally speaking, like, I kind of agree with that. I think the vast majority of us own Bitcoin and we own some other things, right? You're talking about real estate. A lot of people do that. A lot of people own stocks alongside those things. And so when you start thinking about an allocation across these different assets and you start thinking about an actual structured plan, now there's some interesting decisions that need to be made, and there's some thought that you can benefit from to both maximize your wealth, minimize whatever tax burden you might have, and get to a place where you've opening up optionality and you're not just kind of aimlessly stacking with no future in mind. So I think the Bitcoin community can very much benefit from putting some structure and some frameworks around how they think about this. And just as the Bitcoin community can benefit from the FIRE frameworks, the FIRE community, of course, can benefit from bringing in and understanding Bitcoin as a superior form of savings technology to go along with the stocks that they love and some of the real estate that they love. And when they do that, when you start to blend in these this like superior savings technology along with the frameworks that really work to help give people guideposts and give people a structured way of approaching personal finance, you start to open up some very great optionality. It's very, very powerful. So that's what I focus on when I'm writing the newsletter, when I'm talking on YouTube, when I'm talking to you on these types of podcasts, is like, how can we help put structure around personal finance with a Bitcoin lens at the center of it? Because as we are seeing, we were just joking that like nobody cares about Bitcoin anymore. It just feels like the enthusiasm is dead. I mean, it does kind of feel like that, but it's just not true, actually, right? Like what we are still seeing is that it's no longer taboo to own a little bit of Bitcoin. There's so many people who have a little bit of a sleeve here and there. They may not understand what they own or how any of it works, but it's definitely something that more and more people are doing. And as the value of Bitcoin goes up over time, it's going to become a larger portion of their portfolio. Then they're going to start paying attention to it. Number go up technology cures all of these things, right? And so I think it's just important to continue to have these discussions and continue to be in front of not only Bitcoiners, but also the FIRE community to merge these two great frameworks together.
Yeah, I remember last time we talked about how, in general, the FIRE community is very analytical, right? They research a lot. They're trying to, make this, portfolio that works for them, that grows at a certain rate, so they can take out this 4%, right? And this idea of the 4% is you take out 4% each year of your portfolio, and then because of how you've structured it, right, it will grow and recoup the 4 plus another 4 and so on and so on, right? And then
it's based off of something called the Trinity study, yes, which was done back in the 1990s. Mm-hmm. Some researchers were looking at historical stock and bond returns over a 100-year period or so, and fast forward to kind of like the conclusion was that except for maybe 5% of cases, if you withdraw 4% of your portfolio every year to cover your expenses, you will most likely never run out of money, or that portfolio will at least last you for 30 years. Now, there are certain scenarios where, you retire right before the Great Depression, or you retire right before, right before 2008, that might happen, where what's called sequence of withdrawal rate comes to bite you, right? It's like, oh, all of a sudden I just started selling down my portfolio, and my portfolio, as soon as I retired, got cut in half. In those types of certain circumstances, again, assuming that there's no flexibility on the part of the actual participant in this thing, which is not actually accurate, right? Like, people have the ability to react to these types of situations. But assuming that that's not the case, at that point, you might run out of money before the end of 30 years. Yeah. And so that's what all of that was based off of. And it's not meant to be this like perfectly scientific thing. It's not the same thing as like water freezes at 32 degrees Fahrenheit, right? It's meant to be a framework and a guidepost, or the way that it's used in a practical standpoint is like, hey, this can give you a really good idea of a number that you need to be targeting for in order to fund your lifestyle going forward based off of the expenses that you expect to have. Yeah. And then that's based off of the historical growth of the purchasing power of stocks and bonds over that long period of time. So that's where it like starts to bring in this question about Bitcoin. Well, if Bitcoin is expected to go up at least over the next, call it 20, 30 years at a much faster rate than stocks, then you can actually apply a higher withdrawal rate to it, because the math is the math, right? Like that 4% rule is basically saying, okay, stocks are going to grow at 7% real rate over time, and based off of the volatility that we've seen, you're not going to run out of money if you just keep selling it down. And so if you just double the growth rate or 2.5 times the growth rate, then it allows you to also double the withdrawal rate, and you don't run out of money, because the compounding effect of that Bitcoin that you own, even though you're starting to sell it down, it outruns the amount that you're selling down.
If something happened to you tomorrow, could your family access your Bitcoin? Not probably, not they'd figure it out, but with certainty. I've thought about this a lot. Whatever custody solution you are using, inheritance is the piece most people haven't solved yet. Billions in Bitcoin have already been lost because someone died without a plan. With OnRamp, inheritance planning is built directly into your custody setup. Your Bitcoin stays segregated and in your control, secured across independent institutions in multiple jurisdictions, insured through Lloyd's of London, and accessible to the people you choose when they need it. And it doesn't matter where in the world you or they are. You can book a free consultation to learn more at onrampbitcoin.com/Bram. That's onrampbitcoin.com/Bram. Most people stop too early with Bitcoin. They buy it, maybe move it to a wallet and think they are done. But they're not. The real questions are how you're securing it, how private your setup is, and whether you're verifying your own transactions or trusting someone else. And what happens to your Bitcoin when something happens to you? This is the layer that most people ignore, and it's the most important one. That's why I've been working with the Bitcoin Way. They help you set up self-custody properly, including privacy, cybersecurity, inheritance, and even running your own node. And they do it without ever touching your Bitcoin. They're not a custodian. They're your support team. If you're serious about this like I am, go to thebitcoinway.com/Bram, that's BRAM, to book a free call. They'll walk you through your setup, personalize everything to you, and help you get a much stronger position very quickly, whether you're a beginner or more advanced. That's thebitcoinway.com/Bram. Yeah, and so when you determine what the 4% for you would be, right? Let's say, I don't know, 100K a year, then you should have like 2.5 million basically in a portfolio, right? And then you can say like, okay, I hit my FIRE number. And,
that's right.
Now I'm going to start basically taking out this 4% every year, and maybe optimizing the portfolio along the way, but then you kind of like have your start number basically to retire, right?
The inverse of that 4% is to say, start with my annual expenses. If it's 100,000,
yes,
I'm going to multiply that by 25 times.
Yeah, exactly.
And that gets you to your FIRE number. So for every $40,000 of expenses that you have, you need $1 million worth of savings in stocks and bonds, or Bitcoin, of course.
Yeah. And so what percentage of Bitcoin should you add to a portfolio, or is it just Bitcoin, right? Like, is your FIRE Bitcoin journey, is it just a set amount of Bitcoin, or are you introducing it into a portfolio? Like, how are you approaching it? And like, what is the effect of Bitcoin, of applying Bitcoin to, this FIRE philosophy?
Yeah. But as we were saying before, most people own some amount of Bitcoin and some amount of stocks or other assets that would be part of that savings portfolio. So it doesn't make any sense to only focus on one side of that, right? If you, for whatever reason, have a goal that you're saying, okay, I'm going to accumulate Bitcoin and I just don't ever want to touch it, and I'm going to pass all of that on to my family, fine, look at it that way. But then you're not really like taking that into account to determine what your financial independence number is, because it has nothing to do with it's not part of the calculation for what your goals are. In that case, then you're just looking at any other investments that you might be having. So the way that I approach this, and I've got a tool that's out there called the FireBTC Compass, and it's at calc.firebtc.io. And what you can do is put in your expenses. I just released some new functionality in there where it used to be where you just put in like a single number of annual expenses. You can now go in and put in different types of expenses at a line by line level, and it will add it up, and you can add some buffer, and you can add buffer for taxes that you might be paying on capital gains and that kind of thing. So you calculate your number, and then that determines how much you need to retire based on either the 4% rule, or what I like to use and what we have calculating in there is more of a blended withdrawal rate. It's saying, okay, I've got, let's say 50% stocks and 50% Bitcoin. Well, we're going to apply the 4% rule to the stocks, and we're going to apply the 8% rule to the Bitcoin. And so now you come up with like a 6% withdrawal rate across the entirety of your portfolio. Now, there's one other nuance here that's really interesting that I have not yet built into the calculator, but that I'm planning to do, which is that doesn't take into account the order that you withdraw these assets from, right? So the way that I think about this for my own personal finances is, well, the Bitcoin that I own is the last thing that I want to sell because it's the best asset that I could possibly own for the long term. So why don't I model out the withdrawals that I'm going to be happening based on that being the operative approach? So now all of a sudden you could say, okay, well, I've got 50% stocks and 50% Bitcoin. So I can get to like this number of what is my FIRE number. But if I'm going to start drawing down only from the stock side of things to cover my expenses whenever I reach that number, well, now all of a sudden my number is actually a little bit lower because I'm able to give the Bitcoin more time to run and compound at a faster rate because I'm not drawing down I'm not taking, if I have $100,000 worth of expenses, I'm not saying, okay, I'm going to sell $50,000 worth of stocks and $50,000 worth of Bitcoin, which is the way that kind of like the traditional approach would be for traditional FIRE. Instead, I'm going to say, no, I'm going to sell $100,000 worth of stock, and I'm going to totally leave the Bitcoin alone to continue to compound. And the effect of that, which I haven't like done the deep calculations yet, and I will be doing that when I put it into the calculator, but the effect of that is that your number actually will drop a little bit lower because you're giving Bitcoin more room and more time to run because you're not selling it down in those first few years of retirement. I hope that makes sense.
My country, when you have a job, through your employer, you already pay a little bit to, your pension, you build your pension, etc. And it was funny because my fiance got a letter from like the pension fund, and it said like, if you work for like 35 more years at the same company, which it's never going to happen, when you're 65-ish, right, you will receive, and I think it was like 37,000 euros a year or something, right? And I was looking at it and I was like, holy shit, like this is not. It's not motivational, right? Like it is just like who can live off 37,000 euros a year, not net income, right? Like that's before tax income, right?
Yeah.
Like no one.
Which is amazing to me that like some of these government programs for retirement or whatever, like Social Security or this pension thing that's coming from the government. It's like, okay, you've paid into this via tax or whatever. We've saved this up, and then we're going to give it to you, and then we're going to tax it when we give it to you. So this
exactly. And so it's so intransparent, right? That it's just very difficult to unravel. But we were looking at this letter, and I was just thinking, this is just not motivational, right? Like you have an issue today, whether you're into Bitcoin or not, right? Like when you get a letter like that, and she has a great job, like an above average salary also, right? And then to see that you end up with that, my point is where I want to go is like it is not an interesting subject. People are not paying attention, etc. But today you already have a problem, right? Like you have a problem if you see that number for 35 years in the future, right? If there is just 2% inflation every year for 35 years, you've already lost 50% of your purchasing power. I would also argue, right? Like the use case for Bitcoin becomes more clear, but just a step before is like, it's so hard to acknowledge that you have a problem that is very clear in the future, but it's actually already here today. So yeah, how do you think through that?
Yeah, I think what you're getting at is, okay, maybe just a question about the methodology that the Trinity study used was, what about the real purchasing power of this? And that was taken into account as part of the methodology for the study. I think they assumed a 3% inflation rate, which, obviously, first of all, inflation and the purchasing power of the dollars that you have is kind of personal in nature. It's, Michael Saylor has said, inflation is a vector as opposed to a single number. We all know that that's true. My inflation rate is going to be very different than yours based off of the things that I want to spend my money on and the places that I live. And do I like to go out to eat versus cook at home? And, all of these different types of things, right? The permutations are endless. And so, you do need to think about what your personal inflation rate is to some degree. You can actually adjust that in the Compass tool, by the way. It kind of defaults at 3%, but you can adjust that. But it is an important question. It's like, okay, great. We're starting from this nominal value of dollars. We all know that dollars are being debased every single day. Is that really, a good guidepost for what you need if the value of those dollars are going to be constantly melting? I think the other side of that, though, is that we're not talking about cash, right? The amount of money that you have as a FIRE practitioner is all in liquid, growing assets that are benefiting from that debasement as well, right? We've all heard about the K-shaped economy. Asset owners are benefiting from the, amount of debt and just the different cycles that things are going from, and people who don't own assets are suffering. Well, the FIRE community are people who own assets, right? And whether that's stocks or whether that's Bitcoin, it doesn't really matter. You are benefiting from the fact that you own those assets already at these lower valuations, and they're continuing to go up. So then the question is, can you continue to expect that the value of those assets is going to grow faster than the inflation rate that you are experiencing? And that's an answer that I can't give you because I don't know what your particular inflation rate actually is, but something worth considering. I hope that makes sense.
If people then want to use Bitcoin, right? There's a lot of videos on YouTube that say, retire early with Bitcoin. You need 0.1 Bitcoin. I think we both know it works on YouTube, but it's not the number. Right. And before we went live, I will also link to that video in the description. I told you I have my second best podcast is a podcast with Sminston, who made like a retirement calculator based on the power law. And also, I think it takes into account like 7% inflation even, right? Like a pretty big number. So, when you are looking at these numbers, of course, people have different situations, as you just said, right? What do you think is the actual Bitcoin number? Like maybe. Like
I think 0.1 is an actual Bitcoin number. It just depends on your timeline, right?
Yeah, exactly. Okay, but it's not. It's in 30 years, Bitcoin, maybe.
And then you wait 30 years. You might actually have enough, right?
Yeah. Perhaps
that's not what we FIRE people are trying to do. Like we're trying to say, okay, within the next 5 to 10 years, I want to have reached financial independence. So I'm opening up that optionality. Mm-hmm. If that's the case, you probably are going to need a lot more than 0.1 Bitcoin, right? You're right. Like a lot of those memes or thumbnails are hyperbolic, to say the least, because that's the way that the YouTube algorithm likes to work. But that doesn't mean that there's not some truth in it. I think like the underlying message is you might need less than you actually think. I've written a little bit about this. There's a article on my newsletter called Goal Seek, and it is talking about this like blended withdrawal rate that we're talking about. And then it's saying, okay, if I figure out what I need today, I can figure out how much Bitcoin that translates into. And then if I project forward and say, okay, today I would need 12 Bitcoin. Well, if I just wait 5 years and I plan to retire 5 years, I can divide that number by 3. And actually, I only need to get to 4 Bitcoin. And if I wait another 5 years, I can divide that further by 3. And really, I only need 1.2 Bitcoin or whatever that calculation is, right? I call this the rule of 3. Again, this is just a guidepost. There's no hard and fast rule. There's a bunch of assumptions in there, but it's supposed to give you a framework to say, okay, where am I in my career? What is an actual realistic stacking goal that I can see based off of how long I want to work, how long I think it's going to take me, what's my savings rate, all of these different things. And then you can kind of back into, okay, this is the target that I'm going for in terms of the amount of Bitcoin. That number, needs to be taken into account with all of the other assets that you have. And then one thing I wanted to say, when you were talking about the pension or we were talking about Social Security, any income that you have that's coming in, whether it's being debased or not, granted, right? But if you have 30,000 euro coming in, you can subtract that from the annual expense number that you're using as your top line, because that's 30,000 euro that you don't need to come up with by selling down your assets. Yep. And so if your number is 100,000 euro, but you've got 30,000 coming in per year, now actually the bridge that you need to cross is really only 70,000, which lowers the amount of money that you need to save in terms of your savings portfolio. So those different types of like income streams are something that I typically don't talk about as part of this calculation of 25 times your annual expenses, but it's definitely something that you should consider if you think that this is an income stream that you can count on. And then of course, all the same caveats that we were just talking about is like, yes, that 30,000 euro needs to be discounted by a certain type of an inflation rate over time as well, because the purchasing power is going to drop. But you can model all of this stuff out. And over time, I'll be building in all of these different like specifications and modeling into that Compass tool.
Yeah. So it's really about the yearly expenses and also your goal of when you would want to retire, right? So in 2 years, 5 years, 10 years, whenever, right? And then you can calculate that. What kind of CAGR are you using then for Bitcoin? Can you play with that in the tool as well? You
can play with that in the tool. The baseline is 25%, which is actually much more conservative than the power law. A couple words on the power law since you mentioned it before. I also have an article about that. Please go read it. I'm not a power law hater. I'm also not a power law super believer. Like I feel like some people kind of over-index. I call the title of the thing, "All Your Models Will Be Destroyed." I think the power law may be one of those models that also gets destroyed. But I know it's very popular for people to want to use that as some type of non-arbitrary number that they can index to for the growth of Bitcoin. So I added it in. You can turn it into power law mode. And what's funny though, like the power law people I've noticed will come to me and be like, yeah, but Trey, you're talking about 25% forever. Like that's totally wrong. Like look at the power law, it models in for diminishing returns. Great. I actually think that's a pretty good assumption that there's diminishing returns, right? As the asset grows, whatever. But let's not forget, if you look at the power law assumptions over the next like 10 to 15 years, it's higher than 25% per year. It's sometime in like 10 or 12 years from now before the power law assumption crosses below that 25% threshold. So actually, I'm a little bit more conservative in my modeling when I'm just using the 25%. You can play around with it in the tool and put it in for like what you think you want to model toward. And I always try to approach things in a conservative manner because I want to make sure that like I'm not in a position where I have to worry about, am I going to run out of money if I decide I'm done working and I'm only living off of my Bitcoin and my stocks and whatnot.
For my European friends that want to buy Bitcoin with ease, check out Relay. I've been a longtime fan and happy to partner up with what I think is the best Bitcoin-only platform for Europeans. They offer a super simple, beginner-friendly app with no distractions and no shitcoins. You can do a quick one-time smash buy or set up automatic purchases when you're stacking regularly. And here's the thing that matters most. Relay is 100% self-custody. Every set you hold is yours. Your keys, your coins. If you want to get started, download the app via my link below or in the description and use code BRAM, that's BRAM, at checkout to get 10% off your fees. Every Bitcoiner hits this moment. You need cash. Maybe a house deposit, an emergency, or a tax bill, and you're staring at your stack thinking, do I really want to sell this? Here's the thing, you don't have to. You can borrow against your Bitcoin instead, so there's also no taxable event and your stack can keep on stacking. This is where Firefish comes in, a peer-to-peer marketplace for Bitcoin-backed loans. And Firefish isn't a lender. They built the protocol that makes this all possible, which is exactly why they never, ever have to touch your Bitcoin. During your loan, your Bitcoin sits in an on-chain multisig secured by open source code. You can easily create a loan request with your desired amount, duration, and interest rate and share it on their marketplace at firefish.io. When you get matched and decide to accept a loan offer, you can use code BRAM to get 30% off your first loan's fees. That's firefish.io and code BRAM.
Time frame doesn't matter if you have enough, right? Like, let's blow it out to like epic proportions. Let's say you've got like, you know, you spend $100,000 a year and you've got $100 million worth of Bitcoin. Well, if the price drops by 80%, you're fine. You don't have to blink, right? It doesn't matter because you have so much more than enough. So to in some regard, I like to say, oh, look, if you're really worried about that, then just make sure you save more before you retire, right? So I think about, like, for my own personal journey, I would much rather have more volatility in my portfolio, have a bigger nut to draw off of, and then trust the math of like the longer term averages to work themselves out over time, and then approach this plan with flexibility in mind. You're not a robot. If 2022 happens and it goes down by 77% the day after you retire, you're not just going to like pretend like nothing happened, right? Like, there are ways to react. You can cut certain parts of your spending. You can do some maybe geo arbitrage or pick up a side gig or whatever to start plugging some of those holes. So I think, like, again, we like to talk about hard and fast numbers. How much Bitcoin do you really need to retire, right? And we're going to give you a number. All of these frameworks are really important and really interesting, but let's just keep in mind that we are humans who can react to these different situations. And what you want to get yourself into is a position where you've got enough to withstand some volatility, and that you're going into this with a mindset of flexibility so that you can understand how you might react as and when these types of scenarios come to play. And the last thing I'll say to this in answer to your response is, I've got a feature for this in the Compass as well. If you go to, there's a projections tab, and there's something called the bear market stress test. And basically what it does is it does assume that you're selling any stocks that you've got down before you start selling Bitcoin. And it says, could your portfolio as it exists today survive with like over a 30-year time period if 2022 happened, or if the prior bear market back in 2018 happened again. And so you can see, yes, this survived, or no, it didn't, and it lasted you 12 years, assuming that you're selling down at that 4% withdrawal rate or the blended rate that you've got selected there. So all this tooling is fun and very useful to help build comfort in the plan that you've got, so that you can go forward and say, okay, it's time for me to take advantage of the optionality that I built by building this portfolio and start working on my passion projects, start doing more of the traveling, and pull myself out of like the corporate grind, if that's what you've been doing and that you don't want to do anymore, which is the whole goal of this, right? It's the whole goal of this is to give you that optionality. Emphasize the financial independence part of this. I think people get very hung up on like the retire part of this equation here, but it's all about creating that optionality for yourself. Yeah.
I mean, it's really about, creating the time and space to figure out what you want to do, right? So it doesn't mean you have to actually retire. It means you can maybe get out of this rat race, or at least the rat race feeling, right? So that you have time and space to figure out, okay, what is the actual thing that I would like to explore or focus on, etc. Another thing I saw you advocate for, and I thought it was interesting. I think you called it like a stacking sprint. You know, like you should be quick at stacking, like in the cycle. I think comparing that to like the whole FIRE idea, right? Or just in general, when people talk about investing, right? They take this 20, 30 year, or career long time frame, and in that time frame, I'm going to invest, and then I can retire off that. Can you tell a bit more about your idea about this stacking sprint?
Yeah, the stacking sprint is meant to just help people create some urgency and lean into the early part of this journey once you decide that this is what you want to do. And the idea is you've got set a 4-year focused time frame, lines with the Bitcoin halving, right? To say, I'm going to pull out all the stops in terms of increasing my savings rate and buying as much Bitcoin as I possibly can. It's much harder to increase the percentage of your stack later on after the stack has grown. And when like the way that Saylor talks about his businesses and the income statement versus the balance sheet is that, look, the balance sheet can do a whole lot of work for you, way more than scaling income. And that's true at the personal level as well. And I've written quite a bit about this as well, is that you should be managing your personal Bitcoin treasury on building as big of a balance sheet as you possibly can, because the balance sheet is the ballast that allows you to not only protect yourself from this volatility and all of this kind of thing, but builds a wealth compounding engine that is very, very difficult to replicate if you're just looking at the income statement, if you're just trying to grow revenue, if you're just trying to grow your income. And there's a certain point of time that you'll get to where all of a sudden the amount of money that you're making or losing on a monthly basis or a yearly basis, just from the movement of the value of your Bitcoin or of your balance sheet, surpasses that of your income. And when you reach this level, it's kind of like this light switch moment where you're like, wow, this is amazing. And then you fast forward another couple of years, and now it's like multiples of what you're making at your job. And at that point, your job is kind of like your side gig, right? If you really think about it, because your balance sheet is creating a whole lot more wealth for you than your time is in putting into your job. So the stacking sprint is meant to just give people an easy framework to say, okay, I'm pulling out all the stops. I'm going to stack as much, as hard, as fast as I possibly can in that 4-year time window. And I'm going to build this compounding engine, this balance sheet that will get this compounding growth started. And then after that time period, whatever it is for you, I say 4 years, you can kind of start to take your foot off the gas because you've already created this engine that's going to continue to work for you. And you get yourself into a place where any incremental stacking that you do is not going to have that much of an impact relative to what you've already built. Right? Mm-hmm. It's like much harder to go, to grow your stack from 10%, from 5 Bitcoin to 5.5 Bitcoin than it is to grow it 10% from 0.1 to 0.11. Right. Mm-hmm. And so the incremental extra that you're saving, it just has a smaller and smaller impact on the overall wealth that you're able to build. The majority of it is coming from what you've already done. So if that's the case, now you're in a position where you can kind of start to divert some of that savings that you would have otherwise been doing to living a little bit more fully today. You can spend a little bit more. You can take those extra trips. You can do all this stuff safe in the knowledge that the work that you've already done during that sprint is going to carry you forward and get you to a place of financial independence over a certain time period that's not too far away. So that's the total idea there.
When I looked into FIRE before, when we had our previous conversation, and also recently, I think in the FIRE circles, diversification is like a huge word, right? And I think in Bitcoin, it's actually, when someone says like, why would you put your eggs all in one basket and stuff like that? I think the Bitcoiners kind of laugh, right? And I made a whole video about this, that was about, sell Bitcoin for what? Once you understand you don't really own your stocks in your broker app, right? Yeah, well, you understand that it is a certain game that you either want to play or not, right? And I think, do you want to be delusional or not, right? Like it's like stocks is basically playing like a video game. I would say, because it's not. But this is for me. This is how my mind works, right? Like, like you just never own them, right? So it's like you're playing a game, and maybe you're adhering to FIRE principles, etc. You have this whole outlook, basically, right? This is my plan. This is what I'm going to do. But you're basically doing it with tokens or items or whatever in this third-party app. Which in essence, it's just not really yours. And so I think the Bitcoin mindset, I wonder what you think about this, by the way, but like I think the Bitcoin mindset is kind of opposite to that. So yeah, how do you look at that?
So the first thing to say,
quite a big difference.
The first thing to say, and I've kind of posted this on X a few times, is that diversification is just a fancy word that means less Bitcoin. So let's just keep that in mind, right?
like that. Yeah,
if you are buying anything other than Bitcoin, it means you are foregoing having more Bitcoin. And a lot of people will say, oh, I need to have this like emergency fund of, 3 years of expenses, and I need to have some stocks and diversification, real estate and all this. That's fine if that's how you think, but you are foregoing the extra upside that you get from owning Bitcoin. So that's one thing. That's the way I think about it.
Today, also,
I don't really buy,
right. Like also today, because eventually, the price might run away from you.
Yeah, absolutely, yeah. The other like aspect of this, and I think this is where I've really been kind of additive to the FIRE framework, is to just try to help them start thinking about the fact that all of their assets, if they don't own Bitcoin and don't have it in self-custody, are in permissioned environments, right? They're mediated. It's mediated wealth. And there are scenarios where you get locked out of your money. There are scenarios where there's some kind of mistake that either temporarily or permanently keeps you from that hard-earned wealth, and you can handicap this as a long shot, and it probably is for the vast majority of people, but that does not mean that it's a 0% probability. And so it's just something that I think the traditional FIRE community just does not think about at all. There's a very high trust community saying like, yeah, we trust that this is going to continue to work. We trust that all of the, property rights laws in the US are going to continue to be upheld the way that they are. And that's really just not the case, right? Like we've seen, many different times in emergency scenarios or otherwise, where the things that we all held sacred in terms of what we thought were our rights and our property are thrown out the window as soon as that new virus hits or whatever, right? So, so it's something that those traditional financial independence, retire early people need to be thinking about that they're not. And Bitcoin is really the only asset that gives that to you. It's the only asset that at any scale you can control directly for yourself and have full sovereignty over, without anybody else being able to get in the way or in between you and your money. And the proper allocation for Bitcoin in self-custody is absolutely not zero. For people like you and me, it's probably close to 100% in terms of the amount of Bitcoin exposure that you have. But somehow, some way, you need to be thinking about like, how can you own your wealth directly and not be dependent on gatekeepers for 100%? Like talk about diversification, right? You're totally 100% concentrated in a portfolio that could be turned off like a light switch.
Yeah, exactly. I like that. Right? It's so paradoxical, right? Like these people are so analytical, but then it's kind of brushed over. Like this part's kind of brushed over. But I mean, this is Jesse Meyer's "Why the Yuppie Elite Dismisses Bitcoin," right? It is about that trust in institutions, and again, I think we shouldn't have any judgment. I also think it's about kind of about how you're wired, right? And I agree with you. Yeah, it's very much all eggs in one basket if it's just stocks, right? Like in the characteristic of the asset that you're holding. Yeah, that's a really good point. I also feel like, if you're really diversifying, it is also a kind of a tax on your time and thus also your freedom. Like it kind of undermines the whole goal. Because you're still working to constantly optimize the portfolio, right? It's
that's true.
Yeah,
that's true. Yeah, I think like the way that the FIRE community treats the stock market, or their approach to investments, is not really investing at all, right? It's saving, and they're using what they consider to be the best and most liquid savings vehicle that has been out there, which, historically speaking, has been true. You just buy the index fund and you buy as much of it as fast as possible as you can, and then you let that compounding engine do the rest. And that's great if that's the best possible vehicle, but it's not the best possible vehicle anymore. Bitcoin is that vehicle, and you're not actually investing when you're buying stock market index, right? You're not analyzing company balance sheets and P&Ls and revenue projections and PE ratios and doing some type of like due diligence on individual companies. You're just not. You're using that as a savings vehicle. Well, we now have this other savings vehicle that has much higher upside potential, we think, and that allows you to hold it directly and get an extra sovereignty benefit over and above what you can get with stocks. So you not only get financial independence, but you also get financial sovereignty to go alongside of it. And if that's the case, then there's no reason to necessarily be diversified, because you're not really diversifying. You're not investing in any like meaningful sense when you're just buying the index. You're saving.
Well, that would be the rational explainer, right? But also, I mean, if it works for them, it works, right? I think that is something that, I think that's something that I forget a lot, in a sense that I can argue that stocks are shit and you never really truly own them, and then sometimes people come along and they say, well, doesn't really matter. I'm up 30% in 2 years, and so I'm happy.
Totally true.
That's great.
The S&P is at another all-time high again today, right?
Yeah.
So it's during these like shorter time period windows, it does make it a little bit harder to make that argument to people who are like, well, yeah, I mean, what are you talking about? I'm up 30% the last year.
So what would be? I mean, so they are correct today, right? Which we are not arguing with, but like, what do you think that we are seeing that they are not seeing? Is that maybe the longer time frame? Like, do you think this? I don't know how old the FIRE movement is, right? But let's say you discover the FIRE movement today. Do you actually think it is a sustainable strategy for, let's say, the next 30 or 35 years, right? Like, do you think, like again, nominally, it works out. But if we have more than 2% debasement for the next 35 years, it's not really going to work out. But what do you think about that?
Well, I mean, again, that debasement also provides a tailwind to asset owners and to the valuations of those assets, right? So I don't know that that's necessarily like a Achilles heel to the strategy. What I would think about is, the FIRE movement has historically been very U.S. focused, U.S. centric, and the U.S. has been in a very privileged position of being the leader in terms of economic growth, historically speaking. And to the extent that we can expect that will continue into the future, then yeah, absolutely, right? It will continue to work. That wealth engine transfers into the wealth of the companies that are headquartered and operating and whatever out of the US, and the people who own those stocks are going to continue to do very well. That's not guaranteed though. And there's a lot of crazy stuff going on in the world that could potentially undermine the US's position in that wealth growing engine. I'm not predicting that that's going to happen, but there certainly are, in my view, some risks that have been established over the last decade that could undermine that going forward. And if you are not a U.S. citizen or have access to the U.S. stock market and you're pursuing a fire approach, if you are looking at a stock market for some other, emerging market economy that has not performed the way that the U.S. has, well, all of a sudden, it's not at all the right thing to do. You would have been way better off in Bitcoin, of course. And there are a lot of people around the world who don't have access to any stock market at all, let alone the U.S. market that has been and will probably continue to be the leader, right? So I think it's very easy to get focused on the U.S. economy and the U.S. stock market, but there's a very large world out there that just doesn't even have access to that at all. So having a tool that does provide a similar level of savings functionality without having to have gated access to a permissioned environment that is the U.S. stock market through U.S. institutions is hugely valuable. And I think it only becomes more and more valuable over time as more and more people become comfortable with what it is and are seeking ways of growing their wealth and saving for the future that is outside of that permissioned environment. And again, number go up technology tends to speak for itself over longer periods of time. We just have to work our way through these longer periods of sell-offs and recovery.
Yeah, so this is so logical and clear to us, I would say. You had a TradFi background. I believe you were at Goldman Sachs, right? What do you think TradFi totally misses about this whole thing we're talking about and Bitcoin, right? Because what works for an individual and smaller portfolio, I'd say also works for larger capital allocator, right? What? You made that move. You've been working in Bitcoin for a longer time now. But what do you think they still miss? Although I think Goldman also has a Bitcoin ETF right now.
Yeah,
right?
I mean, they're all coming around, right? Everybody bends the knee, given enough time. I think this squarely lands in the yuppie elite scenario here that you were hinting at before, which is that Wall Street, these firms, they sit very close to the money printer. They have easy access to credit. They don't need Bitcoin to the extent that a lot of people do for various other reasons. And so if you don't need something, you have much less of an incentive to actually do the work to understand it and see how it might benefit you. There are a lot of people who are doing just fine without needing something like Bitcoin, and they absolutely have access to stocks. They're able to buy properties in very desirable locations that tend to go up faster than the average home price or whatever. And so I think that really is what it is. It's they don't have a need for it necessarily, but when a new asset like Bitcoin comes in and there's these ETFs and everything, Wall Street's definitely going to figure out a way to monetize that. And that's exactly what they're doing. So you can't stop them from doing it. It's going to continue. I think a rising tide lifts all boats when it comes to access to Bitcoin exposure, which then leads to more people doing the homework to understand what the asset is, why they should hold it directly, actually hold their own keys, and come to a company like Unchained and actually do, hold this thing sovereignly, and get to that point of sovereign ownership of your wealth, like we were talking about before, that the FIRE community needs to be taking seriously. So I really think that's all it is. It's just a matter of time. Again, it's everybody. The days of it being weird or taboo for somebody around you to own Bitcoin are gone. Right? There's so many people who have some type of exposure to it, and it's just not weird anymore. And that will just continue to grow and play out over time, to the point where it becomes more and more meaningful part of people's portfolio and more a part of their everyday lives. and the plans that they make with their financial advisors and their wealth managers and the estate bankers and whatnot that are in these like private wealth groups in these large institutions as well.
Yeah. I think another difference with classical FIRE, this early retirement idea, and you also kind of alluded to it before, right? Like when you're optimizing a portfolio with multiple things in it, some people are also kind of addicted to it, right? Like I've been in these Telegram groups where people talk about this. I've left them because I kind of went crazy, actually. It was like, oh, what should I do this week or should I do that week or whatever? And, as long as you think it is, fun, then it's great to do, right? But isn't the whole goal to actually be more relaxed, right? And I think
to actually not do that. Yeah.
Yeah, exactly. Right. At least, well, that would be my goal, like when thinking about creating time and space for yourself. It's not about optimizing for more constantly. And I think you also talked about something where you shouldn't really believe it, right? Like you should just be able to trust the math, basically. Like how do you think through that kind of like, you can stack relentlessly for 4 years, like you said, like have that sprint, get to XYZ goal, whatever that is for you, right? And then you can actually, hit the brake a little bit, like you said. How do you think through that, or how have you seen other people do that? Like, is it hard if you're not using Bitcoin? Or how can people kind of like make sure that they don't fall into that trap?
Yeah, what I'll say is that this kind of thing and this transition is actually easier said than done. That, and I think this is very normal in the traditional FIRE community as well, is that people start to build very strong muscles for saving and for being somewhat frugal and for like watching what their expenses are, maximizing their savings rate, investing their money or saving their money, and building this wealth engine. And then when it comes time to actually think about the transition into retirement or, stopping doing what you're currently doing so that you can focus on, enjoying the extra optionality that you've created for yourself, it's a little bit scary, because you can look at past historical performance and, feel very comfortable with that while you're still in stacking mode, but you still also have this income that you're generating from your job. And then when you start to like mentally start to flip the switch on, okay, I'm going to actually give all of this stuff up and live off the portfolio, and let's hope this works the way that I have been planning on it, it can be a little bit scary. And you also have to like
those are the posts on Reddit, right? Like it's the day, right? Like it's the day that I'm flipping the switch. Yeah.
Right. And you actually have to start building some new muscles of how to spend your money. Spend extra money that you otherwise would have been saving. Because if you don't do that, you're going to end up in a situation where you're still just like too scared to actually enjoy your life. And that's one of the things I think that we didn't talk about before, but that the stacking sprint and this like sprint and then coast approach is actually really good for. Because if you are still working at the end of your stacking sprint and then you're going into coast mode, as I was mentioning before, now you can start to take your foot off the gas for saving and you can start to spend a little bit of extra money. Well, that's a great time frame to start exercising those new muscles and building some new habits and getting used to actually like spending on the things that would improve your life, that you've been wanting to do and been foregoing over those last 4 or 5 years while you're building that engine. And it's really important actually that we understand how to spend our money just as it is understanding how to save. So I don't know if that answers your question directly or whatever, but definitely some important points there, I think.
Well, I fully agree with this idea of not wanting to spend what you saved before, right? Like that kind of feels weird, but I think it's also because you do need to have a plan. right? Like there needs to be some sort of plan, and then what has always worked for me is to just have dates, like set dates and work towards dates, right? And then because you set a date, it's subconsciously in your head, right? And you work toward it. And I also feel that, I mean, I don't want to say I'm retired, but I do think that at least for my level of how I want to live, I created the time and space to explore and do these things where I'm like fully in control on how that goes and what I spend the time on, right? And so I don't really look at what we're talking about as I'm never going to work again or whatever, but it's more like getting out of, or it's more like getting into more conscious living and thinking and deciding, right? Like less this idea of you being kind of directed by, the machine, or, I'm doing air quotes, the machine or whatever. This idea of just, running on this treadmill just to, kind of stay in place, basically, if you don't mitigate the debasement in any way or form, you're just running. And probably you're running harder every year, and you're not really have that feeling of going forward. But for me, at least, the feeling of going forward is also just the reclaiming of the time, I would say.
Yeah, I think it's very easy, and a lot of people fall into this, and I was one of them, that if you're not very intentional in thinking about designing the lifestyle that you want and designing like what your path is going to be, it's very easy to just kind of get sucked into a particular direction that's based off of whatever previous decisions or circumstances have befallen you up to that point, because the universe kind of rewards action, and inaction is also action. And so like the path of least resistance, unless you're consciously thinking about it, is going to be some kind of logical next step or iteration from whatever the past influences and environments and decisions are that you've made. And so like I've written about this before in the past as well, which is like this kind of like a probability field. It's like the universe has an infinite number of probabilities or possibilities that are out there, and when you take conscious action in one direction, you are bending the probabilities toward that particular future actually coming to be the one that manifests. Right.
Yeah.
And so it doesn't guarantee it.
Well, you're dismissing a lot of other options in the breadth of the option, just because you're not focusing on them, right? Like on
exactly. Exactly. And so like it's like one decision after another bends the probability that the next thing that happens is going to be more in line with the decision that you just made, or the action that you just made. Yeah. And there's no guarantees, but it is this kind of like probabilistic nature of I don't know, Steve Jobs had this thing, right, that he talked about, the reality distortion field or something like that, right?
Well, it's like the infinite decision tree. Right, like you go in a certain direction, and that is where all the stuff will happen, just because you're not on the other side of the tree.
I also think about this like as it relates to LLMs, right? We're all working in eyeballs deep in these AIs and that kind of thing, which are all probabilistic machines. And the word that is generated here has an influence on the next word in a probabilistic manner. It's kind of like that as well, right? The words that are coming out of my mouth are, I don't know, I'm probably going to say the word probably, but you never know, because it's all like you talk like an LLM. That is the way that our minds work, and I think that's the way that the world works. Also, we're really getting down a strange rabbit hole here. But,
no, I like it. I like it. I like that. Yeah.
Think about.
So maybe, I want to ask you two questions to kind of wrap up. One, I'll start with the more negative one. You said, you cannot really afford to own zero Bitcoin. Like, obviously, that is what you and I would say, right? But there's still a lot of people that are following, the traditional finance path and getting into debt for an education and then, their job and etc. Especially also the younger people. How do you look at the future when you say something like, having zero Bitcoin is not what you should be doing? And I was talking about, this kind of like this treadmill that's accelerating and people just staying in place. Is it something that we are just seeing? Do we have a certain foresight? Like, I don't want to, how do you say that, tout my horn, but more like, do you think that we are seeing something that other people are just not seeing? Or is it something totally different, right? Because I do think that we are acting upon a certain image of the future that we think will be true, right? And, we're attempting to do something in the now to mitigate that. We could be horribly wrong, right? But yeah, how do you think about that? Maybe also, when you look at, our generational peers and some people being like super aware of this, other people just, doing the thing that everyone else is doing.
Yeah, I think the momentum of what Bitcoin has created to go from where it started to where it is now is only going to continue. And we see evidence that it is having an impact in the world from the fact that, even 10 years, 8 years ago, whatever, very few people could tell you anything at all about Bitcoin. And now almost everybody has heard about it. And a very large portion of people have some allocation to it, some exposure to it, and they can't explain the difficulty adjustment, but they are financially incentivized for it to do well, and that will only continue to happen. I think the fact that we are not in a Bitcoin standard world is just evidence to the fact that there is a large amount of education that still needs to happen, that it is still actually early. And that the people that we are surrounding ourselves with who have not gotten Bitcoin maybe just don't need it as much, as some people who are around the world are trying to work through an authoritarian regime or move money across borders without having an intermediary or Western Union or whatever, or dealing with some type of actual hyperinflation. For those people, it's very obvious that they either need to get their hands on dollars or they need to get their hands on Bitcoin or some combination of those two things, right? And so that's an educational moment for a lot of people when they're trying to figure out how to just protect their wealth. And some subset of those people come across Bitcoin as a solution for that. And I think as things go forward, the problem that Bitcoin solves for people in the third world versus the developed world are different problem sets. But that doesn't mean that Bitcoin can't come in and help people solve a savings problem and be an example to other people who are also trying to solve that savings problem as an alternative to the stock market or to real estate. Real estate especially is just such a difficult business. I did a podcast for the Fire BTC podcast with Chris Drizga, and we were talking about his experience in real estate and all of this. And I've talked to so many of my friends who have done very well in real estate, and they all say the same thing. It's so difficult. It's a business that's really hard. There's no liquidity. There's fees everywhere. You're constantly managing tenants. It's these people are open to the possibility that Bitcoin could be a better savings vehicle and a better way to generate wealth than what they know. But it does take some time to get to a new frame of reference for how Bitcoin can help. And you start to dabble at first, just like everybody does, just like I did, just like you probably did. And then over time, naturally, as Bitcoin's value increases, it becomes a larger and larger part of people's wealth, whether they want it to or not. And then they start to pay attention a little bit more. And then they start to allocate a little bit more heavily because they're more comfortable with it, because it's been around a little while longer, because the Lindy effect has had more time to ingrain itself across the population. So the grind that we've been through over these last few cycles of euphoric price pumps and a flood of new people coming in, and these drawdowns and lack of enthusiasm that we're kind of currently going through, it's going to continue to happen, but the floor raises over time, and we will continue to just see adoption of Bitcoin in greater and greater magnitudes as that exposure and the surface area of where Bitcoin touches continues to grow. I truly still believe that. We just have to keep grinding through these little mini bear markets. But I don't know. I think we might be on the other side of this one.
I think it's still
famous
50,
last
50.
words.
I think it's still 50-50 on X. I feel that we are kind of true, but let's see. I'm not the chart guy, so I never really talk about that. All right, last question. So if you were 25 today and you didn't have any money saved up, or just a little bit, but you had all the knowledge that you have now, what kind of things would you do in the next 5 years to actually be able to attain this FIRE status?
So I think that if you are 25 and your goal would be by like 35, you could 100% get there. And I would think it starts with a stacking sprint. So between 25 and 30, you're going as hard as you possibly can. You're saving as much based on your current income. You're looking for ways to grow your income so that you can increase your savings capability. You may be starting a family around that time, right? A lot of people kind of late in their 20s, they're starting to think about that. Maybe they're getting married. Maybe not yet. Maybe that's not happening until, the next few years. So like you have this window of opportunity to really go hard and to save and buy as much Bitcoin as you possibly can, and be very, very intentional about doing so. And then when you get to the other side of that, you're probably going to be in a position where you have enough saved up that the next 5 years is going to get you over that finish line of at least opening up a ton of new doors for you to not feel like you have to continue to grind. And at that point, you can continue on whatever path that you actually want to, kind of safe in the knowledge that you've got this huge nest egg that you've built up that you could live off of for, even if it was just like 15 or 20 years, like that's a huge amount of time. You can have a full career or multiple full careers in that time period. So like, I think a lot of people, they think about the long term, like the longest time out. Oh, I need to get to some number so that I can live until I'm 95 and never run out of money and be able to do all these things. Dude, that is so long from now. Like 30 years is so long. You can save up a third of that. You could quit your job. You could go do a number of different things to help supplement your income, follow your passions. And 10 years later, if you had to start over again, you still have a whole nother runway where you could do a new stacking sprint and all this stuff. Like, I think people just need to open their aperture a little bit as to what's actually possible. We've never had more opportunity than we do right now today to start creating new streams of income across so many different surface areas that can allow you to build that balance sheet that's going to do all of this compounding work for you. So just lean into it, like really get intentional. 5 years, 4 years of a stacking sprint, and you're going to come out the other side of that like in such a powerful position.
Awesome, man. Well, that's, I think, a great point to wrap up. I want to thank you for your time. I thought it was really valuable. And let's stay in touch. Thanks, man. I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, if you want to help me shine a light on the message of Bitcoin, please like this video and subscribe to stay connected. I hope to see you for our next episode. Bye.